What if I told you that some of the world's biggest corporations are quietly, and sometimes not so quietly, placing billion-dollar bets on Bitcoin? And what if I told you that this wave of corporate crypto adoption is only getting started? Picture this. A once struggling retailer famous for memes and market chaos suddenly makes headlines for a $300 million move that could redefine its future. At the same time, tech titans with literal mountains of cash are faced with a billion-dollar question: risk it all on digital gold, or watch from the sidelines as rivals reap the rewards? In the high-stakes game of corporate finance, Bitcoin is no longer a fringe experiment. It's becoming a serious and sometimes polarizing asset on balance sheets around the globe. Today, we'll dive deep into the growing phenomenon of companies investing in Bitcoin, ask who's winning, who's losing, and uncover what's really driving this seismic shift in business strategy. Let's rewind for a second. Not too long ago, the idea of a mainstream company holding Bitcoin made Wall Street veterans shudder. Bitcoin was seen as volatile, unregulated, and the province of tech anarchists, not something worthy of a Fortune 500 treasury. But in just a few short years, the landscape has dramatically shifted. One of the earliest trailblazers was MicroStrategy, a business intelligence firm led by the endlessly quotable Michael Saylor. In August 2020, MicroStrategy made international headlines by purchasing over $250 million worth of Bitcoin for its corporate treasury. Saylor's philosophy was simple: our corporate digital asset treasury strategy will strengthen our balance sheet and increase shareholder value. That was a bold claim, and the world took notice. By May 2025, MicroStrategy, now rebranded as Just Strategy, had amassed a jaw-dropping 580,000 Bitcoins. That's a stake valued in the tens of billions at current prices, acquired at an average of nearly $70,000 per coin. Saylor doubled down again and again, ignoring critics and weathering extreme volatility. His multi-year gamble turned MicroStrategy from a niche software vendor into a Wall Street and crypto legend. Bitcoin investment, he argued, provides the opportunity for better returns and preserves the value of our capital over time. Initially, many industry leaders and analysts dismissed this as reckless or even delusional. But then came 2024 and 2025, a period that saw a dramatic acceleration in corporate Bitcoin adoption. According to research from Bitwise Europe, corporate Bitcoin holdings increased by a staggering 100,000 coins in just 1 month of April 2025. Altogether, roughly 750,000 Bitcoins, worth over $80 billion, are now reportedly sitting in company coffers worldwide. It's a cast of surprising characters. GameStop, the video game retailer synonymous with meme stock mania, recently shocked investors by revealing it had bought nearly 5,000 Bitcoin for its own balance sheet. Semler Scientific, a company focused on medical diagnostics, has acquired over 3,100 Bitcoins and declared Bitcoin as its primary treasury reserve asset. Even Bitcoin mining companies like CleanSpark are stockpiling the tokens they produce, with CleanSpark alone holding more than 10,500 Bitcoin as of early 2025. Financial giants are getting in on the action too. BlackRock, the world's largest asset manager, now oversees more than 500,000 Bitcoins under its iBit fund. Major exchanges like Kraken are publicly speculating that within a few years, up to 20% of all public companies could be holding Bitcoin on their books. The race, according to Bitwise's Andre Dragosh, is heating up faster than many expected. But despite the euphoria and sky-high returns for some, Bitcoin is up over 1,000% in the past 5 years. Many companies remain deeply divided. The clearest example? Microsoft, the $3 trillion tech titan flush with over $78 billion in cash reserves. In late 2024, Microsoft's shareholders considered a bold proposal, putting some of that enormous cash pile to work by buying Bitcoin. MicroStrategy's Saylor even presented directly to Microsoft's board, passionately making the case. On paper, the logic was hard to ignore. If Microsoft had invested just 1% of its cash, about $784 million, in Bitcoin that December, the company could have acquired nearly 8,000 Bitcoins. In just 5 months, that stake would have grown to be worth $860 million, a $76.5 million gain, a tidy 9.8% return compared to just 1.8% for Microsoft's own stock over the same period. That's the kind of performance most CFOs dream of. But Microsoft's board and shareholders overwhelmingly rejected the proposal. Their reasoning? Bitcoin's notorious volatility and unpredictable price swings. As one expert from Deloitte summarized, companies using crypto in their businesses should have a clear understanding of why they are undertaking that action. For Microsoft, prudence and stability won out, at least for now. It's a classic dilemma for today's corporate leaders. Should you stick with the tried and true cash, bonds, and blue-chip stocks, or take a calculated risk on digital assets with meteoric but erratic growth? The pressure is mounting. As Michael Saylor likes to say, the future belongs to those who get to Bitcoin first. Let's pause for a second. Imagine being in the boardroom as these decisions are debated. The room is split. Some argue that standing on the sidelines could mean missing out on generational gains. Others warn that a single market shock could turn today's headline profits into tomorrow's embarrassing losses. There's fear, there's greed, and there's the ever-present FOMO, the fear of missing out, pushing even the most conservative companies to reconsider their stance. And the numbers are getting hard to ignore. Over the past year, Bitcoin's returns have dwarfed those of many leading stocks. Since January 2024, Bitcoin jumped more than 15%, while Microsoft stock managed less than 10%. Over a 5-year period, the difference is staggering. Bitcoin up more than 1,000%, Microsoft up just 150%. The opportunity cost is beginning to weigh heavily on executives watching rivals generate windfall gains. But of course, it's not just about the returns. There are deep and complex challenges at play. First, there's the accounting headache. How do you record a highly volatile asset whose value can swing 10% in a single day? What about regulatory uncertainty? Even as some jurisdictions clarify their rules, many corporate finance teams worry about sudden policy changes, surprise taxes, or negative headlines. Stephanie Lemmerman, CFO at crypto exchange Kraken, predicts a tipping point is near. Within a couple of years, I expect that 20% of public companies worldwide could hold Bitcoin on their balance sheets. For that to happen, she notes, we need regulatory clarity and better accounting standards. And then there is the human element, the emotion and psychology driving these decisions. As one Deloitte expert puts it, the terrain of digital assets is a new frontier, and it might require every department to rethink its rules and assumptions. Not everyone is convinced. Detractors highlight Bitcoin's wild price swings and question whether its long-term value can be trusted. The infamous crypto crashes of 2022 and 2023 are still fresh in many executives' minds, reminding them of the immense risks involved. For every success story like MicroStrategy, there are tales of companies who bought high and were forced to write down massive losses in a bear market. Meanwhile, other experts warn about systemic risk. What happens if too many companies tie their reserves to an asset that can fluctuate wildly with global sentiment and market manipulation? What would a regulatory crackdown look like if governments suddenly decided to rein in corporate crypto holdings? There's a real possibility that current trends could reverse overnight, upending carefully laid strategies. Yet ignoring the trend also carries risk. As more companies adopt Bitcoin and its price climbs, staying out becomes harder to justify to shareholders demanding higher returns. As Tim Davis of Deloitte observes, this new digital asset terrain is not just about risk, it's about potential and opportunity. But potential alone doesn't pay the bills unless you know how to harness it. So, the main conflict is clear. The world's most powerful corporations are being forced to choose between safety and speculation, tradition and innovation. Some are all in, hoping to ride the next crypto supercycle to record profits. Others are haunted by memories of past crashes and regulatory hiccups. The gap between early adopters and hesitant giants is widening, and the stakes are higher than ever before. All of this sets up a charged atmosphere as we look forward. Will the world's biggest companies leap into Bitcoin, pushing its adoption and price even higher? Or will caution and uncertainty halt the trend in its tracks? And crucially, who will crack the code for corporate Bitcoin strategy, turning digital risk into real-world rewards? The answer may surprise you. In the second half, we'll dig into the playbooks of companies both bold and cautious, explore the regulatory and technological hurdles ahead, and reveal what happens when corporate titans place their bets on the future of money. As we step into the next chapter of the corporate Bitcoin race, the landscape grows even more electrified and unpredictable. Forces are converging. The astronomical returns of early adopters, increasing regulatory acceptance, and a generational shift in risk appetite are all rewriting the playbook for treasurers and CEOs worldwide. But what happens next? What are the potential consequences for those who leap into Bitcoin and for those who hold back? Picture a boardroom in 2026. The CFO, fresh from a Deloitte workshop on digital assets, presents a slide. Corporate Bitcoin holdings, global trends. The numbers are jaw-dropping. More than 1 million Bitcoin now reside on company balance sheets, up from just 750,000 the previous year. Bitcoin's price has shattered all-time highs, in part because Fortune 500 firms fanned the flames of demand, creating a new feedback loop. Those who acted early, think MicroStrategy, Semler Scientific, GameStop, are celebrated as visionary risk-takers. Their market caps balloon, their executives become regulars on financial news shows. But this corporate gold rush isn't without its shadows. Imagine the same boardroom, but this time the mood is tense. Bitcoin's price has nosedived 40% in the wake of a crypto-specific regulatory shock, perhaps a coordinated tax crackdown, or the announcement of a government-backed digital dollar that siphons away some speculative interest. Suddenly, the Bitcoin holdings that were a badge of honor become a lightning rod for criticism. Earnings calls are dominated by questions about volatility. Activist investors push for de-risking. There's a new maxim: last one in, first one out. All this sets the stage for some critical questions. Will Bitcoin continue to deliver outsized returns, justifying its newfound role as a corporate reserve asset? Will regulatory clarity drive even more companies to allocate a share of their cash reserves to digital assets, or will it close the window altogether? And how will the strategies of the bold, like GameStop and MicroStrategy, compare to the calculated caution of Microsoft and its peers? Let's break down some of the most likely scenarios that could shape the future of corporate Bitcoin adoption. First, the bull case, the optimistic scenario. Here, Bitcoin's limited supply and growing institutional demand trigger an extended price rally. Companies that moved early see their reserves multiply in value. This in turn prompts a cascade of FOMO, fear of missing out, as holdouts worry about lagging behind competitors. According to Stephanie Lemmerman of Kraken, within a couple of years, 20% of the world's 55,000 public companies could be holding Bitcoin. If that prediction materializes, Bitcoin could become as standard in corporate finance as foreign currency reserves or treasury bonds. But the bear case can't be ignored. Regulatory bodies around the world might crack down, introducing strict reporting standards, new taxes, or even outright restrictions on corporate crypto holdings. In such a climate, treasurers who were once lauded for their boldness might suddenly find themselves under legal scrutiny. Public perception could turn, especially if a wave of companies reports major losses from crypto exposure. Tim Davis of Deloitte warns, the terrain of digital assets is a new frontier of possibilities, so it could require that each corporate department rethink the application of their rules. For some firms, that frontier may prove too risky to traverse. And then there's the middle path, a period of maturation. In this scenario, corporate Bitcoin adoption grows steadily but selectively. Policies and accounting rules adapt, guided by input from industry leaders and regulators. Bitcoin is used not just as a speculative reserve, but as a working asset in supply chain finance, cross-border payments, or payroll for global teams. BlackRock's massive iShares Bitcoin Trust, holding over 530,000 Bitcoin, becomes a benchmark for conservative, regulated exposure. Instead of wild swings, we see incremental, disciplined adoption. Whatever path unfolds, one thing is certain. The decision to put Bitcoin on the balance sheet is no longer a fringe experiment. It's an executive-level dilemma, blending finance, technology, and even corporate philosophy. It touches every department: accounting, risk, legal, investor relations, and beyond. So, where does this leave you, the viewer, the investor, the future leader? What are the practical lessons to draw from this breakneck race? First, let's address the obvious. History belongs to the bold. As Michael Saylor of MicroStrategy put it, Bitcoin investment would provide the opportunity for better returns and preserve the value of our capital over time. Saylor's conviction has transformed MicroStrategy from a niche software company to a global icon of digital finance. Their gamble, accumulating more than 580,000 Bitcoin at an average price just below $70,000, has already yielded eye-popping returns. They've sparked an industry-wide debate, pushing peers to reassess their own cash management strategies. But boldness doesn't mean recklessness. As Deloitte's latest report advises, companies using crypto in their businesses should have a clear understanding of why they are undertaking that action. For every game changer like MicroStrategy, there are dozens of would-be followers weighing the risks: volatility, complex accounting, and regulatory uncertainty. Microsoft, for example, passed on Bitcoin, not out of ignorance, but from a calculated analysis of risk versus reward. Their war chest of $78 billion, untouched by the crypto craze, signals a preference for stability and predictability. While they missed out on a $76 million gain in 5 months, a rounding error for a $3 trillion company, that restraint may prove invaluable if the next crypto winter arrives. So, what should you take away from this? If you're an investor, it's a reminder to look beyond the headlines. Bitcoin's volatility is legendary, but so are its long-term returns. Fortune smiles on those who think several moves ahead, those who neither rush in blindly nor hide from innovation. Watching the strategies of corporate giants offers a blueprint. Diversify, assess risk, and keep learning. If Microsoft acts, it'll be after careful policy analysis, not just crowd pressure. If smaller companies jump in, ask yourself, do they have the cash reserves and stomach for wild price swings? If you're an entrepreneur, CFO, or board member, the lesson is even sharper. Digital assets now demand board-level attention. Asking, should our company hold Bitcoin, is only the starting point. The real questions are deeper. How will it affect operational liquidity? What are the tax and regulatory implications? How do you communicate the rationale to shareholders, especially during turbulent periods? Forward-thinking leaders are already drafting contingency plans, consulting specialists, and experimenting with pilot projects, if not with Bitcoin, then with blockchain-based payments or tokenized assets. The winners will be those who approach this new asset class with both courage and discipline. And if you're simply curious or skeptical, remember this: corporate adoption of Bitcoin is still in its early innings. Fong Lei of MicroStrategy noted, "A corporate digital asset treasury strategy can strengthen public and private company balance sheets and increase shareholder value." That's a dramatic shift in mindset from just a few years ago when Bitcoin was largely viewed as a speculative plaything. The world's largest asset managers like BlackRock are now custodians for hundreds of thousands of BTC, proof that the tectonic plates of finance are moving. Let's not forget the bigger picture. The embrace or rejection of Bitcoin by major corporations will ripple far beyond quarterly earnings calls. It could reshape entire industries, from payments to supply chain management to international finance. It will test the adaptability of regulators and the ingenuity of accountants. Most of all, it will challenge each company's appetite for risk, innovation, and change. So, to finally answer today's burning question, will more major companies follow the Bitcoin trend? And how will those who act or don't fare in the long run? The answer is yes, but with important caveats. The next wave of adoption will be bigger, but also smarter. The pioneers, those who acted early, stand to reap the greatest rewards if Bitcoin continues its upward trajectory. Their risk has already paid off handsomely, and their boldness has given them a first-mover advantage in digital asset management and corporate narrative. But those who wait may benefit too, learning from the missteps of others, entering with greater regulatory clarity, and potentially even buying in during market corrections. Yet those who refuse to adapt at all risk more than missed profits. They risk irrelevance as clients, partners, and investors gravitate toward companies seen as forward-thinking, resilient, and innovative. In a world that prizes adaptability, standing still is its own kind of risk. Here's a final secret that most mainstream coverage misses. While headlines obsess over dollar gains and losses, the true prize in the Bitcoin race might not be the coins, but the knowledge and capability that come from navigating this new frontier. The teams who learn to manage digital assets, master regulatory compliance, and communicate transparently with stakeholders. Those are the companies that will define the next era of corporate finance, no matter what happens to Bitcoin's price. So, what about you? Are you ready to ask the big questions? Will your company or your portfolio ride the next wave or watch from the sidelines? Let us know in the comments. Would you want your employer to hold Bitcoin? Should your favorite brand take the leap or sit this one out? And if you found today's story thought-provoking, don't forget to like, subscribe, and share with your fellow future-forward thinkers. Because the race isn't over. The biggest